Certainly the out of the box events certainly became normal in 2016. It's been a very big year for the markets. There's been two big themes. I guess there's been a breakdown of I guess the flight for yield, or the chase for yield, and where those expensive defensives like the AGLs, the Telstras of this world, they've been hit quite hard. Even the banks have been hit quite hard, as investors, I guess, perceive that the risk is too great for the price that they were paying in a rising interest rate sort of world. And Donald Trump played a big part in terms of highlighting that fiscal policy will play more of a role, and that means rising interest rates, or that's what the equity markets are assuming. And in that sort of condition, bonds have been aggressively sold off, and alongside bonds, these stocks that were treated like bonds. It's important in the markets to realise when things get very expensive, because taking profits is just as important as knowing when to buy. So that's what we've been concentrating on this year. And I guess what's happened under Donald Trump is that people, I guess, are looking, are more comfortable with equity-related risk. So those sort of stocks that are cyclical, those stocks like small caps whose earnings are leveraged to economic conditions, people are happier with the risk profile of those stocks. So they're starting to buy, they're buying those stocks, and that's what we're going to be looking at in the next few issues. The big thing for us is that a lot of these stocks that were bought big by the market, like these expensive growth stories, have really been hit hard too. And the thing is that we've been telling people to take profits on those stocks, which we're very proud of. Like Bellamy's has come off from well over $15, $16 at one point to trading below $7, and Certex has gone from trading over $13 to around $15. And another stock which we didn't tip, which just comes to mind, the Telstra reseller, Vita Group, they've halved. So these stocks have gone from trading on huge multiples to still trading on growth multiples, but I guess a lot of the premium has been taken out because people were assuming big earnings growth and they were paying bigger PE multiples for that earnings growth. I think interest rates have been going up ever since the US Fed Reserve, started raising rates this time last year. We have an expression that under the radar, don't fight the Fed. And that means don't stand in the way of, when the Federal Reserve is rising interest rates. So don't chase those yield type stocks. And I think it's important to remember, that you're buying shares not for dividends, but for growth. Because you get your growth from reinvestment of earnings and the compounding effect of return on equity. And that's where small caps really come in, because you've got increased leverage, because you've got a smaller company reinvesting its earnings and generating the kind of return on investment that you just can't get from a bigger company. So although dividends are important because they differentiate a speculative stock from someone who's producing earnings, because dividends don't come from nowhere, they come from profits. So they are an important signal, but they're not to be, that signal isn't to be, taken to its extreme, and that is the only reason you're buying the stock, for the dividend, because the dividend can be cut very easily when things don't happen, because dividends rank well behind creditors and bondholders, or debt creditors in terms of payment priorities for a company. Well, we try and invest in good companies, sure, but we also look for paying good prices. So we don't want to overpay. So I guess a key element in terms of our success in recent stories is even though Bellamy's is halved and it's trading at under $7, we still got in at $2.80. So if you're not paying much for a company, then if the market does fall, you're a lot more protected because those stocks you're not paying much in the first place. So those sort of investments can withhold collapsing markets. Whereas I guess a growth story, once that growth factor comes off, then there's no reason for people to own it anymore, and they do get hit a lot harder. And another factor that we look at is the balance sheet. So we're very keen to understand what kind of fixed obligations companies have, because at the smaller end, solvency is a much bigger question. We saw that in the financial crisis, where a lot of stocks got carted, but the bigger cap stocks, they got bailed out by shareholders. Whereas at the smaller end, you are a lot more vulnerable to the winds of economic misfortune.